Ever wondered how to pick the best North American dividend-paying stocks? Well, you're not alone. The world of investing can be a labyrinth of numbers, terms, and strategies, especially when it comes to dividend-paying stocks. These stocks, my friends, are like the golden geese of the investment world. They not only offer the potential for capital growth, but also provide a steady stream of income regardless of market conditions. And that's precisely what makes them so appealing to investors. However, knowing how to pick the best ones, especially in the vast North American market, can be quite a challenge. That's where this video comes into play. Our objective is to help you understand the process of selecting the cream of the crop, the dividend-paying stocks that can potentially give your investment portfolio a significant boost. By the end of this video, you should have a clear idea of how to start your investment journey with dividend-paying stocks. First off, what exactly are dividends? Dividends are essentially a slice of a company's profits, distributed to shareholders as a token of appreciation for their investment. Imagine having a piece of pie. In this case, the pie is the company's profits, and the slice you receive is the dividend. The size of each slice depends on how many shares you own. The more shares, the bigger your piece of the pie. So why would a company choose to share this pie, their hard-earned profits? Well, companies that pay dividends are often stable and profitable, with enough earnings to share. It's their way of saying, thank you for believing in us, here's a piece of our success. Now, why should you, as an investor, care about dividends? One word: income. Dividends provide a steady stream of income in addition to any potential capital gains. This can be particularly beneficial if you're nearing retirement and looking for more predictability in your investment returns. And it's not just about the here and now. Reinvesting these dividends can significantly enhance your investment over time. It's a little like rolling a snowball down a hill. The further it rolls, the bigger it gets. That's the power of compounding returns. But what about companies that don't pay dividends? Well, they might choose to reinvest all their profits back into the business, fueling growth and, ideally, leading to an increase in the stock price. While this can be a profitable strategy, it's a bit more dependent on the market's ups and downs. So, dividends aren't just about immediate gratification, they're about long-term growth and stability. They're about sharing in a company's success today and reinvesting for even greater success tomorrow. Dividends can be a significant part of your investment strategy, providing a regular income stream alongside potential capital gains. So the next time you're evaluating a potential investment, don't forget to consider the dividends. It could be the cherry on top of your investment pie. Now that you know what dividends are, how do you identify stocks that pay high dividends? Well, it's not as challenging as it might initially seem. The key is to know what indicators to look for. Two of the most crucial indicators are dividend yield and payout ratio. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's calculated by dividing the annual dividend payment by the market price per share. A higher dividend yield could mean the stock is undervalued, or the company is doing really well and sharing its profits generously. On the other hand, the payout ratio is another significant metric. It's the proportion of earnings a company pays shareholders in dividends, expressed as a percentage. The payout ratio gives you an idea of how well a company's earnings support the dividend payments. More mature companies tend to have higher payout ratios, they have less to reinvest in growth, so they distribute more back to shareholders. But how do you find these numbers? Well, you don't have to be a Wall Street analyst with a Bloomberg terminal. There are numerous financial websites and tools available that provide this information. Websites like Yahoo Finance, Google Finance, and others offer comprehensive financial data for thousands of publicly traded companies. You can easily find a company's dividend yield and payout ratio there. However, keep in mind that while a high dividend yield is attractive, it's not the only factor to consider when choosing stocks. A company with a high yield but poor growth prospects or shaky financials might not be a great investment. Also, a company with a very high payout ratio may not be sustainable in the long run. If a company is paying out most of its earnings as dividends, it may not have enough left to invest in its own growth. So as with all things investing, balance is key. Look for companies with high but not excessive dividend yields and payout ratios, and always consider these numbers in the context of the company's overall financial health. Remember, a high dividend yield is attractive, but it's not the only factor to consider when picking stocks. Once you've identified potential high dividend stocks, it's time to evaluate the company behind them. This process is a bit like detective work, but don't worry, We're not talking about dusty files and trench coats here. Now, why is this evaluation important? Well, the financial health of a company directly impacts its ability to pay dividends. A financially unstable company might cut or eliminate dividends during tough times, leaving you, the investor, in the lurch. So, what indicators should you look for? The company's balance sheet is a good starting point. Consider its debt levels. A company with manageable debt is more likely to maintain or increase its dividends. Then dig into the company's earnings. Is revenue growing? Are profits increasing? If the answer is yes, that's a positive sign. It implies the company is performing well and could continue to pay dividends. Next, consider the company's payout ratio. This is the percentage of earnings a company pays out as dividends. A payout ratio of more than 50% might seem attractive at first glance, but it could also signal that the company is not reinvesting enough in its own growth. Apart from financials, you should also evaluate the company's dividend history. Has the company consistently paid dividends over time? Has it increased its dividend payouts? Consistency and growth in dividend payments are signs of a company's commitment to returning profits to shareholders. Now, you might be wondering, where can you find all this information? Most of it is available in the company's annual reports and financial statements, which are typically published on the company's website. You can also use financial news websites and investment research platforms for additional insight. Remember, the goal is not just to find a company that pays high dividends, but also one that has the potential to sustain these payments in the future. The company's overall health and dividend history can give you important clues about its future dividend payouts. Now you have some promising stocks in mind, but how many should you invest in? A crucial question indeed. Well, the answer lies in a concept known as diversification. Diversification is the practice of spreading your investments around to reduce risk. It's like the old saying, don't put all your eggs in one basket. Instead of investing all your capital in a single stock, or even only in high dividend stocks, it's often wise to spread it across a variety of investments. This could include a mix of high dividend stocks, growth stocks, and even bonds or other asset classes. Why is this important? Let's consider an example. Say you've invested all your money in the telecommunications sector because it offers attractive dividends. Now, what happens if there's a sudden downturn in that industry? Your entire portfolio would take a hit. But if you had diversified your investments across different sectors, the impact on your portfolio would have been cushioned. Now let's talk about balancing your portfolio. It's not just about having different types of investments, but also about the proportion of each. A common strategy is a mix of high dividend and growth stocks. High dividend stocks, as we discussed earlier, can provide a steady income stream. On the other hand, growth stocks, while they may not pay dividends, have the potential for substantial price appreciation. The exact mix would depend on your financial goals, risk tolerance, and investment horizon. For instance, if you're nearing retirement and need a steady income, you might lean towards high dividend stocks. But if you're young and can afford to take more risk for potentially higher returns, you might prefer a larger portion of growth stocks. So how many stocks should you invest in? There's no one-size-fits-all answer. A widely accepted suggestion is between 20 to 30 different stocks across various sectors. This number allows for diversification without spreading your investments too thin. Remember, diversification is key to managing risk in your investment portfolio. It's about balancing risk and reward and ultimately helping your money work harder for you. So, you're ready to start picking dividend stocks. What's next? We've journeyed through the basics of understanding dividends, identifying high dividend stocks, evaluating the company, and even managing your portfolio. These are your newly acquired compass and map in the vast world of investing. Remember, dividends are payments made by corporations to their shareholders, a slice of the profit pie. High dividend stocks are those that offer a greater yield, but they require careful selection. Evaluating the company behind the stock is crucial. Look for financial stability, a history of dividend payments, and a bright future. Diversification is key to managing risk. Don't put all your eggs in one basket. Spread your investments across different sectors and companies. With these tools, you're well equipped to start your research and embark on your investment journey. Investing in dividend stocks can be a rewarding journey. Start researching, stay informed, and you'll be on your way to building a successful dividend portfolio. Don't forget to subscribe to Caffeinated Money for more investment tips and strategies.
Hello, financial enthusiasts. Welcome to another informative session with Caffeinated Money. We're your go-to hub for all things finance, where we break down complex concepts into easily digestible insights. Today, we've brewed up something exceptionally interesting for you. We're going to delve into the world of dividend investing, a strategy that holds great potential for consistent income generation. But how do you go about it? How do you pick the right stocks that pay dividends? Well, that's precisely what we're about to uncover. We'll guide you through the process, unravel the key considerations, and help you make informed decisions. So sit back, grab your cup of coffee, and let's get started on this journey to financial acumen. Before diving into the topic, make sure to hit the subscribe button and turn on the notifications so you never miss any of our educational content. First things first, what is dividend investing? Now, this is a question that's crucial to understanding the stock market. Dividend investing is a strategy that focuses on buying shares in companies that regularly pay dividends. Dividends are portions of a company's earnings that are distributed to shareholders, usually on a quarterly basis. But why is dividend investing beneficial? Well, one of the most attractive aspects of dividend investing is the potential for a steady stream of income. When you invest in a dividend-paying stock, you're essentially becoming a part owner of that company. As the company profits, so do you, receiving your share of the earnings in the form of dividends. So imagine you've got a collection of these dividend-paying stocks in your portfolio. Over time, these dividends can add up, potentially providing you with a consistent income. And the best part? This income is generally passive, meaning you're earning money without having to actively work for it. Now let's talk about the basics of dividend yield and dividend growth. The dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. In simple terms, it gives you an idea of the return you'll get from the dividend alone. On the other hand, dividend growth refers to the annual rate at which the dividend payout is increasing. Companies with a history of consistent dividend growth are often seen as reliable and financially stable, making them attractive for long-term investment. But here's the catch. High dividend yield doesn't always mean a good investment. It's crucial to consider other factors, such as the company's financial health, market position, and growth prospects. So, dividend investing is a great way to generate passive income. But how do you pick the right stocks? Well, that's a whole other topic, and we're going to dive right into it in the next scene. So keep watching to unlock the secrets of successful dividend investing. Choosing the right dividend stocks is crucial for your financial success. Now that we've unraveled the concept of dividend investing, let's dive into how to pick the right dividend stocks. When selecting dividend stocks, you should first examine the company's financial health. This involves checking out the balance sheet and income statement. A company in good financial health typically has low debt, strong cash flow, and steady earnings. These factors suggest that the company can continue paying dividends consistently, which is what you're looking for as an investor. Next, consider the payout ratio, a key metric in dividend investing. The payout ratio is the percentage of earnings a company pays out to shareholders in the form of dividends. A lower payout ratio suggests that a company is retaining more of its earnings for growth, which could lead to higher dividends in the future. However, a high payout ratio isn't necessarily a red flag. It could mean that the company is mature and has less need for reinvestment. The key is to strike a balance. Another crucial factor is the company's dividend history. Consistent dividend payments over a long period indicate a company's commitment to returning capital to shareholders. If a company has a history of cutting dividends, that might be a sign to steer clear. Now, let's talk about diversification. Spreading your investments across different sectors helps to mitigate risk. If one sector underperforms, your other investments can help cushion the blow. It's all about not putting all your eggs in one basket. Finally, look beyond the dividend. A high dividend yield can be enticing, but it's not the be-all and end-all. You should also consider the company's potential for growth and stability. After all, investing is a long-term game. Remember, the goal is not just to pick stocks with high dividends, but also those with potential for growth and stability. So keep these factors in mind as you build your dividend portfolio. Happy investing! Now that we understand the basics, let's go through some examples. Imagine you're on a quest, hunting for the golden goose of dividend stocks. You're armed with the knowledge of what makes a good dividend stock: solid fundamentals, consistent dividend growth, and a reasonable payout ratio. Let's dive into a few examples of stocks that fit these criteria. First off, let's talk about a company that's been a staple in the world of dividend investing: Procter & Gamble. If you've ever brushed your teeth, washed your hair, or done your laundry, chances are you've used a Procter & Gamble product. They own a massive portfolio of household brands, and they've been paying dividends for over a century. They've also increased their dividend every year for the past 6 decades. That's the kind of consistency you want in a dividend stock. Now let's consider a company from the tech sector, Microsoft. Yes, the tech sector isn't typically known for dividends, but Microsoft is an exception. They've been paying dividends since 2003, and they've consistently increased their dividend every year. What makes Microsoft a good pick? Their strong fundamentals, consistent dividend growth, and sustainable payout ratio. Plus, they're a leader in a growth industry, which bodes well for their future prospects. Next, let's look at a company from the healthcare sector, Johnson & Johnson. This company is a perfect example of a dividend aristocrat. They've been paying dividends for over 50 years and have increased their dividend every year for the past 5 decades. They have a diverse product portfolio including consumer goods, pharmaceuticals, and medical devices, which helps them maintain steady cash flow. Finally, let's talk about a company from the financial sector, JP Morgan Chase. They've been paying dividends since the late 1800s and have consistently increased their dividend over the past decade. They have a solid balance sheet, and their dividend yield is attractive. Now these are just examples, not recommendations. The point here is to illustrate what good dividend stocks look like, and why they are considered good picks. Notice how each of these companies has a history of paying dividends, strong fundamentals, and a sustainable payout ratio. They're all leaders in their respective industries and have resilient business models that allow them to weather economic downturns. Remember, investing in dividend stocks is not just about the yield. It's about the total return, the combination of capital gains and dividends. And while past performance is not a guarantee of future results, a track record of consistent dividends can be a good indicator of a company's financial health and commitment to returning capital to shareholders. These examples should give you a better idea of what to look for when picking dividend stocks. To recap, we've learned about dividend investing and how to pick the right stocks. We've delved into the world of dividends, understanding how they can provide a steady stream of income and add a layer of stability to your investment portfolio. Unlike some other forms of investing, dividends are not just about speculation. They are about owning a piece of a profitable company that shares its success with its shareholders. We've also explored how to identify the right dividend stocks. It's not as simple as choosing the stocks with the highest yields. Factors like the company's financial health, its dividend history, and its position within its industry are all critical considerations. Remember, a high yield might be enticing, but it's the sustainability of those dividends that truly matters. We've discussed the importance of a company's payout ratio, which tells us what portion of its earnings is being given back to shareholders. A ratio that's too high might signal financial stress, while a ratio that's too low could indicate missed opportunities for investor returns. Finding that balance is key. And let's not forget about diversification. Spreading your investments across different industries and companies can help manage risk. It's like the old saying goes, don't put all your eggs in one basket. Diversification can help ensure that a poor performance by a single stock doesn't significantly impact your overall portfolio. But most importantly, we've emphasized the need for ongoing learning and research. The world of investing is constantly evolving, and staying informed is essential for success. There's no substitute for doing your own homework and making informed decisions based on your personal financial goals. And that's a wrap. Remember to do your research and never stop learning. Don't forget to subscribe for more financial tips and tricks. Until next time, this is Caffeinated Money signing off.
Understanding dividend-paying stocks. Let's start by understanding dividend-paying stocks in detail. Simply put, these are shares of companies that distribute a portion of their profits back to their shareholders in the form of dividends. These dividends are typically paid out regularly, usually quarterly, and provide investors with a steady income stream. The power of passive income. One of the most significant advantages of dividend-paying stocks is the generation of passive income. By owning shares in dividend-paying companies, investors can receive consistent payouts without selling any of their shares. This passive income can serve as a reliable source of cash flow, making it an attractive option for both retirees and individuals seeking financial independence. If you're part of the 50% that aren't subscribed yet, please hit that subscribe button, give us a like and comment what you would like for me to cover next. Thanks. Stability in volatile markets. In times of market volatility, dividend-paying stocks can act as a cushion, providing stability to your investment portfolio. Companies that pay dividends tend to be more established and financially robust, making them less susceptible to drastic price fluctuations. This characteristic can provide a buffer against market downturns, reducing overall investment risk. Dividends as a signal of financial health. Dividend payments also serve as a valuable indicator of a company's financial health. A consistent history of paying dividends, and even better, increasing them over time, reflects a company's profitability and confidence in its future growth prospects. Savvy investors use this information to gauge the overall health and potential of a company before investing. Reinvesting dividends for compounding growth. Perhaps one of the most compelling aspects of dividend investing is the power of compounding. By reinvesting dividends back into the same dividend-paying stocks or other investments, investors can experience exponential growth over time. This compounding effect can significantly accelerate wealth accumulation and help investors achieve their long-term financial goals faster. Tax advantages of dividend investing. Beyond the financial benefits, dividend investing offers certain tax advantages. In many jurisdictions, dividends are often taxed at a lower rate than regular income, allowing investors to keep more of their earnings. Understanding and utilizing these tax advantages can further enhance the attractiveness of dividend-paying stocks as part of your investment strategy. Building a diversified dividend portfolio. To maximize the potential of dividend investing, it's essential to build a diversified dividend portfolio. By investing in various companies across different sectors, industries, and regions, you can spread your risk and ensure a more stable income stream. Diversification is a key principle of successful investing, and it certainly applies to dividend stocks as well. Identifying high-quality dividend stocks. Before jumping into dividend investing, it's crucial to identify high-quality dividend stocks. Factors such as the company's dividend history, payout ratio, earnings growth, and overall financial stability should be carefully assessed. We'll walk you through some key metrics and tips to help you make informed investment decisions. The pros of dividend-paying stocks. Now that we've explored the various benefits of dividend-paying stocks, let's summarize the key pros. 1. Steady income stream. Dividends provide a reliable and predictable income stream, especially for income-oriented investors. 2. Stability. Dividend-paying companies tend to be more stable and resilient in challenging economic conditions. 3. Long-term growth. Reinvesting dividends can harness the power of compounding, leading to significant long-term wealth accumulation. 4. Lower tax rates. Dividends are often taxed at favorable rates, reducing the tax burden on your investment income. 5. Signals financial health. Consistent dividend payments can indicate a company's strong financial position and potential for growth. The cons of dividend-paying stocks. It's essential to consider both sides of the coin when investing. Let's discuss some potential drawbacks of dividend-paying stocks. 1. Limited growth potential. Some high-growth companies may not pay dividends, which means missing out on potential capital appreciation. 2. Interest rate sensitivity. In a rising interest rate environment, dividend stocks may become less attractive compared to other investments. 3. Dividend reductions. Companies facing financial difficulties may cut or suspend dividend payments, impacting your income stream. 4. Tax implications. While dividends often have favorable tax treatment, they are still taxable income, and tax laws may change in the future. 5. Diversification challenges. Limited sectors or industries may offer attractive dividend stocks, making it challenging to build a highly diversified portfolio. The art of dividend growth investing. Beyond traditional dividend investing, we'll explore the art of dividend growth investing. This strategy focuses on selecting companies with a history of increasing their dividend payments consistently over time. Discover how this approach can supercharge your wealth-building journey. Dividend reinvestment plans, DRIPs, and ETFs. Let's explore two valuable tools for dividend investors: dividend reinvestment plans, DRIPs, and dividend ETFs. DRIPs allow you to automatically reinvest dividends, while dividend ETFs offer diversified exposure to a basket of dividend-paying stocks. Learn how these options can optimize your portfolio's performance. Real-world dividend portfolio examples. To gain practical insights, we'll examine real-world dividend portfolios of successful investors. Analyze their strategies, portfolio allocations, and thought process to understand how you can tailor your approach to suit your unique financial goals. Well, we've covered an extensive range of topics related to dividend-paying stocks and dividend investing. It's crucial to weigh the pros and cons carefully and align your investment strategy with your financial objectives. Remember, there's no one-size-fits-all approach, so take the time to understand your risk tolerance and investment horizon. Thank you so much for joining us on this dividend investing journey. If you found this video valuable, don't forget to hit that like button, subscribe to our channel, and click the notification bell to stay updated with more insightful content.
Ladies and gentlemen and fellow investors, I stand before you today to discuss a topic of great importance and potential for wealth creation: Canadian dividend aristocrats on the Toronto Stock Exchange, TSX. Dividend aristocrats are companies that have a proven track record of consistently increasing their dividends over an extended period. These companies have demonstrated stability, resilience, and a commitment to rewarding their shareholders. In Canada, the TSX is home to several esteemed dividend aristocrats, which have not only weathered economic storms but have also continued to thrive and deliver consistent returns. Today, I will shed light on the significance of dividend aristocrats, explore the advantages of investing in these companies, and provide you with some examples of exceptional Canadian dividend aristocrats on the TSX. Firstly, let us understand why dividend aristocrats are highly sought after by investors. Dividends are a crucial aspect of investing, as they provide a steady income stream regardless of market conditions. Dividend aristocrats offer a unique blend of stability, income, and potential for long-term capital appreciation. By investing in companies with a history of increasing dividends, investors can benefit from compounding returns and the power of consistent wealth creation. Furthermore, dividend aristocrats tend to exhibit strong fundamentals and sustainable business models. These companies typically have a competitive advantage in their respective industries, enjoy steady cash flows, and possess solid balance sheets. Their ability to consistently increase dividends signifies management's confidence in the company's future prospects, financial health, and commitment to creating value for shareholders. Now, let's turn our attention to the Canadian dividend aristocrats specifically listed on the TSX. Canada boasts a robust and diverse economy, with companies spanning various sectors that have a long history of rewarding shareholders. These dividend aristocrats represent a wide range of industries, including banking, utilities, telecommunications, consumer goods, and more. One exemplary Canadian dividend aristocrat is the Bank of Nova Scotia, TSX, BNS. With over 180 years of operations, Scotiabank has established itself as a reliable and consistent dividend payer. It has increased its dividend for 10 consecutive years, highlighting its commitment to rewarding shareholders even in challenging times. The bank's strong market position, global presence, and focus on emerging markets make it an attractive long-term investment opportunity. Another notable dividend aristocrat on the TSX is Enbridge Incorporated, TSX, ENB. Enbridge is a leading energy infrastructure company that operates an extensive network of pipelines, storage terminals, and renewable energy assets. It has an impressive dividend growth history, having increased its dividend for 26 consecutive years. Enbridge's business model benefits from the essential nature of energy transportation and its diversified asset base, making it a reliable income generator for investors. Furthermore, Canadian Utilities Limited, TSX, CU, stands as a prominent dividend aristocrat with a remarkable dividend growth track record. As a diversified utility company, Canadian Utilities operates in various segments, including electricity, natural gas, and global energy infrastructure. It has increased its dividend for an impressive 49 consecutive years, making it one of the most reliable and enduring dividend pairs on the TSX. These examples are just a glimpse of the many dividend aristocrats on the TSX. Investing in Canadian dividend aristocrats can provide investors with an attractive combination of income, stability, and long-term growth potential. However, it is crucial to conduct thorough research, assess each company's financials, and consider the macroeconomic environment before making any investment decisions. In conclusion, Canadian dividend aristocrats on the TSX represent an enticing investment opportunity for individuals seeking steady income and long-term capital appreciation. These companies have a proven history of rewarding shareholders and embody the qualities of stability, resilience, and sustainable growth. By investing in dividend aristocrats, investors can build a portfolio that generates consistent income, harnesses the power of compounding returns, and withstands market volatility. Let's delve deeper into the concept of dividend aristocrats and explore their key characteristics and advantages. Dividend aristocrats are companies that have a consistent track record of increasing their dividends year after year. They typically belong to well-established industries and have a history of stability, profitability, and reliable cash flows. These companies often possess strong competitive advantages, solid management teams, and a commitment to shareholder value. One of the primary advantages of investing in dividend aristocrats is the income they provide to investors. Dividends serve as a regular stream of cash flow, making them particularly appealing for income-focused investors, retirees, and those seeking a reliable source of passive income. By reinvesting dividends, investors can benefit from the power of compounding, allowing their investment to grow over time. Moreover, dividend aristocrats tend to exhibit lower volatility compared to other stocks. Their ability to consistently increase dividends reflects financial strength and resilience, indicating that these companies have weathered economic downturns and maintained their dividend payouts even during challenging times. This stability can help cushion the impact of market fluctuations and provide a sense of security to investors. Investing in dividend aristocrats also aligns with a long-term investment strategy. These companies often have sustainable business models, solid fundamentals, and a history of adapting to changing market conditions. Their ability to consistently increase dividends demonstrates a management team's confidence in the company's future prospects and commitment to delivering value to shareholders. As a result, dividend aristocrats have the potential to generate both income and capital appreciation over the long term. Furthermore, dividend aristocrats tend to attract a certain class of investors who prioritize stability and income. This demand can contribute to increased liquidity in the stock, potentially resulting in narrower bid-ask spreads and improved trading conditions for investors. Additionally, dividend aristocrats often enjoy a favorable reputation among institutional investors, further boosting their attractiveness and potentially leading to increased demand and price appreciation. When it comes to Canadian dividend aristocrats on the TSX, investors can find a diverse range of companies across various sectors. The Canadian market offers opportunities in sectors such as banking, utilities, telecommunications, consumer goods, energy, and more. This diversification allows investors to build a well-rounded portfolio and potentially mitigate risk by not relying solely on one industry or sector. In conclusion, dividend aristocrats are highly regarded for their consistent dividend growth, stability, and potential for long-term wealth creation. By investing in these companies, individuals can benefit from regular income, the power of compounding returns, lower volatility, and the potential